Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 353 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the SpaceX IPO, what history says about strong stock performance through April and May, inflation concerns, and the latest debate on how you should use your health saving accounts. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So welcome everybody, and welcome to newer listeners. I usually am joined by my co-host Matt Jessup, but he is out of the office attending to other business. So today's episode is going to be a solo-sode with me. And as always, before we get into the main meat of the show, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on June 3rd. S&P 500 index is down 0.3% so far for the month of June, but up 10.3% on the year. Dow Jones Industrial Average down 0.7% for the month and up 5.5% for the year. The NASDAQ Composite Index down 0.4% for the month, up 15.5% for the year. The Russell 2000 Small Cap Index down 1% for the month and up 16.9% for the year. And the Vanguard All World X United States Index Fund is up 0.2% for the month and up 14.4% for the year. 3-month Treasury rate at 3.78%, the 2-year Treasury rate at 4.08%, and the 10-year at 4.49%. So moving into some big headlines and current events from this past week, I think the biggest news is that SpaceX, Elon Musk's private aerospace and space exploration company, is preparing for an initial public offering, or an IPO, sometime this summer. And this is actually projected to be the largest IPO in history. So before I get into a couple statistics that I want to share about IPOs, I just want to break that down and talk about a little bit what it is. So an initial public offering, or IPO, is when a private company sells shares of its business to the public for the first time on a stock exchange. So before an IPO, the company is usually owned by founders, employees, and private investors, and everyday retail traders or retail investors do not have access to own part of these private companies. But during an IPO, the company goes public, meaning everyday investors can now buy shares of the company's stock. So why do companies do this? Companies do this to raise money, grow the business, pay off debt, or allow early investors to cash out some of their ownership. And for whatever reason, I feel like it's been this way at least since I've been in the industry. Retail investors love trying to get in on popular IPOs early, but what I've found is that I usually like to wait a year at least before considering buying a stock that has recently gone public. IPOs can just be extremely volatile, and there's a lot of money that could be made or lost within the first few days or first few weeks of trading. And we have to remember that a great company doesn't always translate to being a great stock, and vice versa. So you got to remember too, these private companies that go public, they have several private investors that are looking to cash out or get at least some of their money out when that stock does go public, and they're selling to all of the retail investors that are generating the hype around the new IPO. So you're automatically going to have a lot of selling pressure there to push the stock price down after it starts trading. So, not every IPO does poorly the first few weeks of trading. Not every IPO does great the first few weeks of trading, but I think it's just important to point out that they do tend to be pretty volatile, so you have to understand that before you get into it. And to back all this up, I wanted to share some data from the Eugene Brigham Department of Finance, Insurance, and Real Estate at the Warrington College of Business at the University of Florida. And they did a study on nearly 10,000 IPOs since 1980 and had the following information for us. They said that the average IPO underperformed the broader market by more than 20% over its first 3 years, and nearly 60% of those companies delivered a return of 0% or less in the 3 years after going public. So again, just because there's a lot of hype around a company, it doesn't mean that the company needs to do well after their IPO. And then lastly, just wrapping up on this point, I saw a post on X from the Long Investor this morning that caught my attention. And he said Amazon's revenue is 4,200% higher than that of SpaceX, but its valuation is only 40% higher. Amazon is undervalued, or SpaceX is in deep trouble after its IPO. So I just thought that was interesting, that, one of the most successful companies in the world, Amazon, generates significantly more revenue than SpaceX at this point. But if, SpaceX IPOs at its projected price and valuation, the valuation of Amazon would only be 40% higher. So I guess that just goes to show you how much the hype is for a company like SpaceX.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So moving into tweets, articles, and research from this week, the first thing I had was a post from Ryan Dietrich on X on May 3rd. So Jenna will throw up this chart for viewers on our YouTube page. It'll also be in our show notes. But Ryan said 23 of the last 25 times the S&P 500 was up more than 5% heading into May, like it was this year, saw the rest of the year higher. A good start to 2026 could be another clue the bull market is alive and well. So what this chart shows is the S&P 500 performance after it was up 5% heading into the month of May. So if we look at all of these returns, or the last 25 instances that this happened, the rest of the year tended to be higher 92% of the time for an average return of just under 9%. So, I do think this is another piece of research that lends to the bulls that, just because we've had this, 9 straight weeks of positive returns in the market, it doesn't mean that the rest of the year has to end poorly or we have to have another major pullback. We could, but it doesn't mean that it has to be that way. And along those same lines, my second piece was a post from X from Astra Insights on May 1st. Again, Jenna will put this up on the YouTube video. It'll be in our show notes, but they show a chart of the S&P 500 and its forward returns after it has a 10% plus monthly gain, like it did in April. So Astra said the S&P 500 was up over 10% in April. We've seen 10% plus monthly gains about 13 times since 1950. Historically, these kinds of powerful upside moves have tended to signal momentum continuation, not exhaustion. 6 months to 1 year later has seen the index higher 85% of the time. And again, if you take a look at this chart over these previous instances, 1 year later, there's only been 2 occasions where the market has been negative. The average return, it looks like, has been about 14%. And again, close to 85% of the time, returns 1 year later are positive. So kind of goes back to the theory that Matt and I talk about a lot on the show, is that strength begets strength, and that it's not a bad thing if you are buying new all-time highs. So just wanted to throw that out there, that A lot of people are calling for a severe pullback, and I agree that at some point, the continuation of 9 straight positive weeks for the S&P 500 will come to an end. It might even come to an end this week. But again, doesn't mean long term that this bull market is done yet. And the last thing I had was a blog post from Jason Pers on May 2nd titled 1968 was the worst time to retire and it's happening again. I just wanted to read a few lines from Jason's blog post. So he says, inflation, not crashes, is what quietly destroys portfolios over time. 1968 was the worst possible time to retire, not because stocks crashed overnight or one catastrophic event. Inflation showed up and it didn't leave. That's the part most people get wrong. They think the big risk is a crash, a sudden drawdown, something obvious. It's not. The real risk is slow and it sits there year after year, quietly destroying your purchasing power while your portfolio looks fine on the surface. From 1968 to the early 1980s, the cost of living nearly tripled. Inflation peaked at 13.5%. And that one force, more than any bear market, destroyed portfolios. When inflation rises, your withdrawals rise with it. And once those withdrawals increase, they don't come back down. That's how your portfolio goes to zero, not in a crash, but over time. And I'm not saying this or reiterating this to spread fear, but I think we have to be open to the idea that inflation could stick around for longer than people think. And we're starting to see some signs that suggest it might. And I just want to go through a couple of those. So one of the big themes that we're following closely right now is the trend in interest rates. So interest rates tend to trend for several decades at a time. And we were in essentially a falling interest rate environment from 1981 through 2020. That's 39 years. But since 2020, interest rates have been steadily rising. Will that continue over the next decade? Your guess is as good as mine. But I think the reality of the situation is that if we do transition to this higher inflationary environment for a prolonged period of time, which means we'll probably be in a rising rate environment for a longer period of time, we have to be honest that most money managers haven't managed money during a rising rate environment. So I think that that's something that we just need to be aware of, especially when we're talking about fixed income, because bonds and interest rates have that inverse relationship. When bond prices are going up, rates are usually coming down and vice versa. Another interesting thing is that energy and commodities in general tend to lead the move higher before interest rates go. And energy prices and commodities have been breaking out and have been rising to start this year. So there are a couple of pieces of research, that make a pretty strong case for us being in a longer term rising rate environment. And again, if you look over history, these rate cycles tend to happen in 30, 40-year periods. So they are very long term. And that doesn't mean that stocks are automatically going to suffer, because we've seen several times throughout history where stocks have done well during rising rate environments. But the reality is, again, most people haven't managed money during a period of time like that. And I also wanted to highlight this because, during periods of rising inflation, cash is not your friend, right? Purchasing power erodes away and the value of your dollars sitting in cash decreases, even though, you might think that might be the safest place for your money. So more of a different post than what we usually talk about here on the show, but I thought it was interesting and just wanted to give my 2 cents on it. Moving on to the last section of the show, the financial planning topic of the week. This was a blog post from the White Coat Investor on May 12th, titled 4 Reasons Why We're Spending Our HSA Money Now and Why You Should Too. So let's start with the basics of HSA accounts or health savings accounts before we get into Jim's blog post. So HSAs are triple tax-free accounts. You get an above-the-line tax deduction worth thousands of dollars in saved tax when you put the money in. It grows tax-free like your Roth IRA or your 401k. And when you take out the money, it comes out completely tax-free like your Roth IRA, as long as it's spent on healthcare expenses. And if you don't need the money for healthcare, you can take the money out after age 65 and spend it on whatever you want with no penalties. You would just have to pay ordinary income tax on the money like you do with a traditional IRA or a pre-tax traditional 401k distribution. And the interesting thing is you don't even have to pull the money out in the same year you spend it on healthcare. You can actually keep the receipts throughout your working years, hold them for a long period of time, and then pull out an amount of money equal to your receipts that you've saved for decades, tax-free, and spend it on whatever you like. So let's say, you're retired and over the past 20 years, you have receipts for medical expenses that total up to $15,000, let's say. Well, if you've kept those receipts, you can take out $15,000 from your HSA and spend it on whatever you want without any penalties or tax consequences associated with that. And that's become a good strategy for high earners. They just pay for medical costs out of pocket so that they have kind of this secondary retirement account that they can pull from when they do decide to get out of the workforce. But Jim lists several reasons why they're spending their HSA as they go for medical expenses rather than building the account up and using it as a secondary retirement account. And I just want to mention a few of those. So the first one he lists is the hassle factor. He says, our strategy prior to 2025 was to pay for all our healthcare needs using post-tax money. We wanted to take a minute and tell you about a service we personally
saving our
use
receipts
so we can
trust.
pull out that
LifeLock
money
by
in a few
Norton.
decades.
With everything we do
use the
online these
tax-free
days,
protecting
protecting
your
your
identity.
However,
and
that
personal
requires us to
information is
actually
more
save
important
the
than
receipts.
ever. You have
That's
to keep
why
the
we've
receipts
partnered
organized,
with
scan them
LifeLock,
to a
a leader
folder,
in
and
the
risk
identity
losing the
theft
receipts to an
protection
issue with your
industry.
computer.
Their
It's
mission
just
is
not
to
worth it
empower
us.
people
I've got
to
better
live
things
their
to do with
digital
my free
lives
time
safely,
than
offering
organize
tools to
my
help protect
receipts.
you and
So
your
that is
family
one
from
big
threats
thing,
like
because if you do
identity
get audited
theft,
by the IRS,
cybercrime,
you do have
and
to produce
fraud.
those
They
receipts to
combine
prove
advanced
that you had
technology with
medical
24/7
expenses you
support
paid
to
for
keep
out
your
of pocket, that you
information
didn't
safer
use
in
your
today's
HSA,
connected
so
world.
now you can
We
turn
use it
around and pull that
ourselves,
money
and we
out of
think
the
it's a
HSA
valuable
to
tool
spend
for
it on
anyone
whatever
looking
you
to
want.
add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock. The second one is an interesting one that I'd never really even thought of, but it's a great point, and that is that receipts are not adjusted for inflation. So a $1,000 receipt now will end up being worth much, much less than $1,000 when you use it to pull money out of your HSA in a few decades. So we just had a whole conversation about inflation. I don't think I need to beat that dead horse anymore. But this is something that I think a lot of people don't necessarily think about. $1,000 today is not going to buy you the same $1,000 in the next 10 years, right? And then the last one is that the tax loophole might close. So Congress actually is now actively discussing limiting the quote unquote save receipt strategy to just 2 years. So the risk there is that people who have been using the save receipt strategy for decades won't be grandfathered in, and all that extra effort that they put in of saving their receipts throughout time might be for nothing. Now, there hasn't been any final action on that, but that is a tax loophole that has the potential of getting closed over the next couple of years. So I'm not advocating for one strategy over the other because I think it depends on your personal financial situation, and it's definitely something to think about. I mean, me up until this point, just based on my situation, try to pay for healthcare costs out of pocket as much as possible so we can just continue to build that HSA up. But again, we might be in a situation in a couple of years where that loophole is gone, right? And especially if we're going into a period where we're going to be experiencing higher than average inflation over the next decade or two, then that's something that might make me change my mind about me and my family's personal situation.
So that's all I had. Again, for newer listeners, usually me and my business partner and co-host Matt Jessup are on the show. Usually go back and forth about a few things, but today is just me. Typically, the show lasts anywhere between 30 and 40 minutes when both of us are on. Usually, it's a little quicker when it's just one of us, when one of us can't make it due to scheduling issues. So just want to take a moment and thank everyone for listening to episode 353 of the Independent Advisors podcast. Catch us next week for episode 354.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.